So again, John Vance, founder and president of Vance Wealth, and we are going to be diving into our annual market and economic update. So here's just some disclosures. I think the big one that comes out of this is that past performance is not indicative of future results. A lot of the things that I illustrate are using charting, not only in the past, but also looking ahead. So it's important to know that. All right, so let's just dive right in and do a little review here of 2023. And you're going to see some themes as we're going through this. Our first topic for today is the stock market review of 2023. I love this starting slide because if you look at the top, it says Investor 2023, and it's the recession playbook. So all of 23 was pretty much plagued by this idea of the recession is imminent and investments are not going to do well, meaning stocks aren't going to do well, real estate's not going to do well, the consumer's not going to do well, that we're heading into a recession. And too often every time we start a year, there tends to be a fair amount of fear and greed in the system. Fear drives investors to make short-term decisions, not long-term decisions. And the same thing with greed. People tend to be potentially greedy and not make really sound decisions. And so this is just a healthy reminder. Like Fortune is a fairly well-respected publication, and this was what their advice to basically advisors were: be on the lookout for a recession. Here's our playbook. And the performance for 2023 was anything but a recessionary environment. So a lot of data here. As you know, I like to be data heavy. So the market's had a great year. Now, when we look at all the colors on the screen here, from left to right, the left shows when we're in a bear market, when we have a bear year. So these shows, all of this data shows calendar year performance going back to 1926. So almost 100 years of data. And it represents when we had a bear market, which is down 20%, which is represented in red. And on the far right-hand side is when we talk about having a great year, that's greater than 20% returns for the broad markets. And that's on the green side. So you can look at the where this data basically kind of scatters on this table that I have here. And you can see great year has happened 37 times over the past, let's say, 100 years. One of the things that's important to know, so we had a great year last year in spite of all the headwinds. And, one of the things that we do recognize, we're big believers of understanding investor psychology. The reality is when people tend to be more pessimistic, that's when markets tend to be stronger. Right now, we're starting the year with some optimism. So this might be a reason why we want to be a little bit more cautious. But if you look at the long term, so last year represented by this is representative of the S&P 500, was up 26%, and the U.S. stock market average going all the way back to 1926 is averaged 10.3%. So you can see returns are varied over the course of 100 years, but it's really important to understand, this is a long-term, we're investing for the long term, and we have to take the good and the bad. And fortunately, we're coming out of a really good, strong year. One of the things that caught the headlines throughout the year is this chart. On the left-hand side, it shows you an index of what's known as the Magnificent Seven. So if you follow the financial journals, you'll know that the Magnificent Seven have been really the drivers of the stock market results. So you can see that blue squiggly line that shows the strength of all those investments, which basically means those 7 stocks were up over 70% collectively. And on the right-hand side, you can see what these companies are: Apple, Microsoft, Google, Amazon, NVIDIA, Facebook, Tesla. Those are the 7 companies. And then you look at on this chart on the left-hand side, it shows you basically the MSCI, it's ACWI, which is all cap world index. So it's looking at the entire world. And you can see the returns were positive, but not that strong. So the returns for the all cap market was great at 22%. You can see it on the right-hand side, that's highlighted in yellow. But the NASDAQ and the tech-heavy sector did significantly better. So this was interesting to see this level of concentration in these big companies. One of the things, just to add to that, technology was another strong performer. And those of you who attended last year or just follow the markets, 2022 was a really terrible year for technology. Losses were down over 30%. So they bounced back nicely, which, that tends to happen with markets. The leaders of yesterday sometimes are the underperformers of today, and vice versa, where things that are underperforming tend to or can have years where they outperform the following year. And so just wanted to give you a breakdown here. On the right-hand side, it shows what the world markets did from a value perspective as well as a growth. So this past year was definitely dominated by the growth markets. And I think a lot of that, there's a bunch of different reasons why. We did get a bounce because of the weakness in 2022, but we also saw a real big boom on the AI side of things, artificial intelligence, and that drove some of the excitement for investors to be adding money to growth stocks. One of the things, though, when we look at, okay, this happened last year, so what does that mean on a go-forward basis, right? Because when we're looking at investing, we're using a rear view mirror to look in the past and to assess what's happened, but we don't want to use that as a guide for the future, because oftentimes, we take like a contrarian perspective, which means what happened in the past doesn't necessarily mean it's going to happen in the future. And actually, this data point here will show you that, when we have times where we get what's called market concentration, where we get a small part of the market driving returns, that actually the broad markets tend to do better following those periods of time. So a few things that I do want to highlight. On the left-hand side, what this data shows is that it's basically showing the 5 best and worst years for a broad market. So the broad market is the entire S&P 500. And actually, in this example, it's using MSCI World, which is the even broader scope of companies, versus just looking at a very narrow market, which is what the Magnificent Seven were. And so on the bottom left-hand corner, it shows you that we had a period of time where the broad market really underperformed in 1997 and 1998. Now, I know that's a long time ago, that's 25 years ago, but if you look at the right-hand side, after a period of a pretty high underperformance of the broad market, you can see this box on the right-hand side shows you that essentially 2000, 2001, all the way through 2006, a more broadly diversified portfolio outperformed a more concentrated one. So that gives us some hope that, we're coming out of this environment potentially where we saw the Magnificent Seven drive the results, and that we do think in this year, especially, and probably for some years to come, is that that's going to broaden out and we're going to get some more participation from other companies. So what's my advice as we recap this? Number one, rebalance portfolio. We're already doing this on behalf of our clients. So I know we have a mix today of clients and guests. So rebalance your portfolio. Make sure you have the appropriate balance between growth and value, large cap and a small and mid portfolio, US and international. And then I think the advice for this year, and this frankly goes for every year, but I do think because we had such a strong year last year, market valuations are a little rich, so they're a little bit more expensive. Clearly, when you have a strong year, market valuations aren't as attractive. There are some continued recessionary risks, even though I think that they were overplayed last year. We still aren't out of the woods. We still have some challenges ahead. And then there's obviously this massive geopolitical risk that's happening around the world that will likely lead to some continued volatility. So be prepared for that. The successful investor understands that these things happen and that we need to be prepared and kind of emotionally prepared to handle the volatility in the portfolio. All right, next topic, we're going to cover bonds and cash equivalents. This is really the fixed income category of your investments, right? This is kind of what we all like to think of as some of the boring and safe investments within the portfolio. So as we look at last year, so I have a similar chart that shows range of returns in the bond market. Now, I do apologize. This screen is a little hard to read, but I think you'll get the gist of it. And so in looking at this chart, right in the middle, it shows the rates of returns that you get that we've gotten on the bond market. And these are the two in the middle are the ones that happen most of the time. So over the last 100 years, we're looking at 2 periods of 29 years where returns were in the yellow between 0 to 3% return. And then the next bucket is 3 to 7% return. So last year, the broad market returned 5.5%. So it was a strong year for the bond market. And all of us kind of know this, right? Money markets and the banks, well, the banks aren't really paying more, but money markets are paying more, and you're starting to actually get paid on some of your safe money. And then you can see the outliers, which doesn't happen very frequently. And the one that I want to have you pay especially close attention to is the one on the far left. And this is what we call a bear year. The bear year happened last year. 2022 was down 13% for the broad bond market. That was the worst year we've seen in essentially 100 years. So it shows you how rare that was that it occurred last year. And that is behind us. And we do expect the bond markets to deliver more solid results on a go-forward basis, primarily because the Federal Reserve over the last 2 years has been raising interest rates. They have now finally paused. And when you raise interest rates, the value of bonds go down. So that's what we lived through in 2022. But 2023 was a strong year at plus 5.5%. So one of the things that we've been having constant dialogue with clients is, where should I be putting my safe money? That might be money that's accumulating in your bank, traditional bank savings, CDs. Should I go into bonds? Why not just leave it in money market? That's a lot of the chatter that we're seeing. And so one of the things that we do know is that historically, after the Federal Reserve stops raising rates, which according to the Federal Reserve, they have. So we are right now in a pause environment where they've stopped raising rates, and most forecasters are predicting that we're going to see a drop or a cut of interest rates here over the next 6 months or so. And one of the things that we have seen is that historically stocks and bonds have outpaced cash. And so on the left-hand side, and I'll get this highlighted here, and this is really important. So 1 year following the Fed rate hike, cash and cash equivalents tend to do okay. 4.7% is not too bad. But 5 years following, cash equivalents are down to 3%. And so one of the things we want to be mindful of is when we're looking at the portfolio, and we're doing this on your behalf, is that you want to be mindful about diversifying, owning longer term assets like stocks, having shorter term assets like bonds, and even emergency or really safe assets like cash, and be mindful about that. It's too attractive, I think, for many people to park money in T-bills and some other safe investments because the yields are so attractive. But the reality is, if the Fed starts cutting rates later, you're going to want to be in bonds that will preserve, they'll likely preserve a higher yield. Because if you get into an environment, I'll show you here next, is if we just wait and cash yields go down, then you're not going to be happy just sitting in money market accounts or T-bills. So this basically shows, basically how fast do cash yields fall. So that's been something that I think a lot of the conversation we've had is, well, if I can make this in this account right now with limited risk because it's a money market account, why should I invest it? And that's a fair question. And the reason is because rates aren't likely to stay at these levels for this long. And if we look back at some historically at a time when rates came back down, we have two charts on here. On the left-hand side, this basically was during the dot-com bubble and also right prior to September 11th. So March of 2001, you could get a money market rate of 5.8%. By March 2002, rates had dropped down to 2.6. So you see a big cut. And then by July of 2002, we got down to 1.8, right? So you feel comfortable with keeping it in this investment. But once rates decline, if you didn't lock it into something that's a little bit longer in term, and then you're not protecting yourself from rates coming down. The example on the right is during the financial crisis, basically getting a high of interest rates in October of 2007. And then seeing rates cut because of the global financial crisis, where now money market rates went down substantially. So this happens pretty quickly, right? So we're looking at 16 months in one and 15 months on the other. So we want to be mindful of that. So as investors, we want to be ahead of that. We don't want to wait for this to happen and just react to it. We want to know this is a likely probable event that's going to occur. And we want to make sure we get ahead of that and reposition the portfolio so that we're not just stuck holding a bunch of cash when rates drop. So just some high-level summary here on the bond market, bonds in the overall market, fixed income investments for 2024. Our recommendations: start reducing your money market, start reducing your T-bill exposure, start reducing your short-term bond exposure. Now, that is all appropriate for short-term needs. Anything that you're going to need to potentially spend, whether that's in a tax bill, in monthly cash flow because you're retired, or you have an asset like another piece of real estate you want to buy, anything that is you might need to spend in the next 2 years should still be in these types of investments. But any other assets that are longer term in nature, we want to make sure we increase the duration, go longer term, and we want to focus on higher quality bonds versus lower quality. Okay, so most of you have been following the market. We had a really strong fourth quarter. So the markets rallied even though pessimism was high, right? So that was one of the things going into the fourth quarter. There was tons of pessimism, recession's coming, recession's looming. And what happened? Well, let's look at this. So from November 1st to the end of the year, a blended portfolio, or I should say a balanced portfolio, which is a 60-40, 60% S&P 500, 40% US bond aggregate index. It was basically, it was up 11.9%. And it was the best 2-month return since the 1980s. Then we look at the stock market. Stock market return on the S&P, 13.7% over those two months. It was the 12th best 2-month return since 1950. So you look back over the last 75 years, and this is one of the 12th best 2-month returns. And then bond returns up 8.5%. Best 2-month return since the 1980s. So it shows you that, there was a lot of pessimism. The Federal Reserve's inflation numbers started to improve, and the markets rallied off of this. And a lot of it is because there's a lot of cash on the sideline. And again, when pessimism is high, that tends to drive investment into these types of vehicles. So the other part here, some of the same data, but the reality is, this was such a strong period of time. And, historically, when we have, those types of streaks, that the bond rally will likely continue. So you can see historically, when we look at some of these best bond months, that the returns actually persisted. We do have a couple negative returns in the mix, but generally we start seeing stronger returns in the bond market. And frankly, that's what we're expecting. We don't have a crystal ball, but that's what we are expecting. But coming back to full circle, we had a great rally in the markets. A big part of our discipline here in the first quarter, make sure we rebalance portfolios, get them back into alignment, because you never know what's ahead of us. But that just gives you a quick snapshot of what happened in the fourth quarter of 2023. All right, I did this slide last year. I think heading into January of last year, there was a lot of pessimism. So we wanted to shed some light on be optimistic. And the easiest way to be optimistic about the world is don't focus on the world. Don't focus on the economy. Actually focus on your goals. Focus on your time horizon, right? Your goals, what's important to you? What do you need to spend money on? Time horizon, when do you need to do it by? Because when you do that, it allows you to be optimistic, because all this noise that's out there, it's never going away. It just changes. It doesn't miraculously go away. It just adjusts. Whatever the headline of the day is, it changes every single day, every single year. And so we just have to accept that as part of being an investor, part of being a human being. And so, but it doesn't do us any good. So here's some reasons to be optimistic. So we got a couple fun magazine covers here, right? On the left-hand side, we're looking at 1974, Gerald Ford. This is actually the year I was born. Inflation, trying to fight inflation, right? We had inflation issues, recession issues, and oil issues. Then at the start of last year, we had Fortune put out the Recession Playbook. And so we know that magazine articles, news publications, the nightly news, they tend to play on fear. They want to create some pain, some panic, some cause for concerns. We know to be a successful investor, you got to take a long-term approach. And so when we start looking at the data, I want to share with you why, since 1974, markets have done so well. And again, we're looking at a 50-year period. So just getting back to some of this data, January 11th of last year, so a full year ago, we had the 50th anniversary of the greatest post-World War II bull market ever. In the following 21 months, though, in the following 21 months, going back 50 years ago, the S&P declined 48%. That was the largest decline that we'd ever seen since the Great Depression. But if you go back to that time, January 1993, and invested $10,000, again, 50 years ago, and let that compound, and including reinvesting dividends, your 10,000 would have grown to 1.25 million. Again, and that's during a period of high inflation, oil shocks, recession, and Watergate. So this just shows you that during that time, there was a lot of fear going on. The Time magazine article shows that. But the reality is when you have a long-term approach, you know that things are going to get better, but there's always reasons to be pessimistic. But that's what we have to avoid as investors, is really focus on optimism. Oh, I can't read that. Sorry, I overlaid that on top of each other. So basically, one of the things that we do like to spend some time on is this idea of like diversification. We all know, sometimes being optimistic is hard because when we have a narrow or a short-term view of life or view of the markets, it's easy to see volatility. It's easy to see problems. But when we look at things with a long-term perspective, when you look back, okay, what was the world like 50 years ago? Are we better off today? It starts to allow you to be more optimistic. And so on the left-hand side, what I just circled here in red, this basically shows some interesting data, right? This goes back to 1950s. So we're looking at 75 years or so of data. And the green represents the stock market, the blue represents the bond market, and the gray represents a balanced portfolio, 60-40. So what this shows us, I'm just going to highlight actually the green in this example. The green shows us that since 1950, the best one-year return on stocks was up 47%. and the worst 1 year return was down 39. So when you go into any given year, we're starting 2024, that is the range of outcomes that has happened in the past. We don't know, are we going to be in an up 47% year or a down 38% year? I don't know. Nobody knows. We can take guesses, but nobody has a crystal ball. So that's the reality of what we know, is it is unknown. However, when we flip this over to when we look at 20-year periods, so again, contrasting a 1-year view and looking at a 20-year view and going back to 1950, what you can see there when we just focus again on the green is a 20-year average annual return. The best 20-year period was up 17%, and the worst 20-year period was up 6%. That was the worst. So as you start, and you can see along this, I have a 1 year, a 5 year, a 10 year, and a 20 year. So the longer the perspective that we have, the more we can be optimistic, the more we know things can work out. But when you're in the middle of any given year, it's hard to be optimistic, but that's really important, again, to be a successful investor. And this is just another chart that illustrates essentially the same thing. This is the chaos of any given year. Now, this data only goes back to 1980, but what I highlighted here on the right-hand side, it shows, and I'll just highlight the past 2 years. So I put in a red box the past 2 years. And so in 2022, the gray line or the gray bar represents that the market at the end of the year lost 19%. That was the return for the year. But during the year, you can see the red dot represents that the market was actually down at some point 25%. And then this past year, we finished the year up 24%, represented in the black. And then you can see the dot below says negative 10%. So during the year last year, we had a period where we were down 10% from the high. So the reality is all of these gray and dark bar charts and these dots, these red dots, show the volatility and kind of some of the controlled chaos that happens in the markets. And the reality is that, when we look back over the last 44 years, that 33 of them were positive, but the average intra-year drop, meaning throughout the year, was an average of 14.2%. So again, that just tells us we have to expect this stuff. And so a big part of why I like doing these updates is that, we can get caught up in the, again, in the news cycle, and we lose sight of some of these long-term trends. And that's what's really important to be a disciplined investor. It's why you've hired Vance Wealth to help guide you through these periods of time and to help avoid making poor decisions. Another big thing when you start dealing with this idea of optimism, this chart is what's called the Consumer Confidence Index. And it basically has the Consumer Confidence Index overlaid with the markets. And the whole idea here, what we're looking at, this goes back to 1971. And so we're looking at a 50-year plus period. And you can see this up and down with the lines. The up and down represents the University of Michigan Consumer Sentiment Index. So when the chart, you can see a dotted line that's running through. That dotted line represents kind of an average sentiment. Where are we on average? So if you're above the average, that means generally you have more optimism. When you are below the average, you have more pessimism. So one of the things when you look in the top left, and it shows the average subsequent 12-month returns, when you had a peak in sentiment, which means peak optimism, and then you have a period of sentiment troughs, which is peak pessimism. The stock market has averaged over those periods of time 3.5% when you have peak optimism, and it's averaged 24.1% at peak pessimism. So what does that tell you again? When people are pessimistic, that's generally a better time to invest. And so if you look at the far right-hand side here on our chart that I have circled, in June of 2022, that was actually an all-time low for the Consumer Confidence Index. And since then, the markets have rallied pretty strong. And so again, this just comes back to this whole idea that markets climb a wall of worry. Pessimism and worry is built into it. That's where we have to buck the trend and make sure we're taking a longer-term approach. And Nick Murray is someone in our business, the financial services business, that provides a lot of insight around helping advisors really understand the behavioral dynamics of clients and helping them navigate through challenging markets environments. And one of my favorite quotes that he has is, "I don't worry about which way the next 20% move in the market will be, because I know exactly which way the next 100% move will be. And I can't run the risk of missing that move." And so that just comes back to the importance of being a long-term investor. As we know, when you look at stock market, real estate market, growth markets, over time, they're likely to go higher and continue to go higher. And that sometimes when we get too focused on that next short-term move, we miss the long-term move, which obviously we want to avoid. And this is this is a chart that just shows a bullish signal for the markets, even though I think we have some cautious optimism going into this year. You can look at cash and cash levels. And at the end of the day, what causes markets to go up? When there's more buyers than sellers. What causes there to be more buyers than sellers? Cash. So when there's cash on the sideline, cash usually likes to find a home. What is that home? That home is usually the stock market, the bond market, the real estate market. So you can see the levels of cash that we have right now. Now, when we go back and actually look at some previous market sell-offs, and this is right in the middle, it shows basically the sell-off and the low in the markets during the financial crisis was March 9th of 2009. And basically, you can see on the left, it shows you when the cash peaked out, which was within 2 months of that. And then if you look at the pandemic, where the trough of the market was when it sold off, when COVID started, and then where the cash peak was 2 months after that. So this just shows you when cash is hitting these higher and higher and higher levels, that generally means there's still some room to move higher. And I mean, look at these numbers actually in these last two big crises: 6-month returns, 55% from the global financial crisis and 46% from the pandemic. I don't expect this is going to be the outcome. However, there might be a lot more strong returns built into this market just because of the cash, and the cash might need to find a home and find a home soon. So be optimistic, focus on your goals and on your time horizon, and make good decisions. All right, we're going to do some high-level economic updates and really just kind of assess what's happening with our balance sheet, both at the government level and at the consumer level. So federal finances, lots of noise on here. We all know that the federal government and our budget is out of control. We continue to borrow more and more money. You can see on the left-hand side, it shows all the sources of our spending, and it shows us how much we're borrowing. So in 2023, we borrowed 28% of what we spent. So our total spending was $6 trillion. We borrowed almost 1.7. This is not sustainable. This has been going on too long. So we have, hold on here, just got a little message. The spending has been out of control. We basically, during kind of essentially post September 11th, we've had presidents from Bush to Obama to Trump to Biden. And I feel like with each of those, each of those have essentially doubled or tripled the prior deficit. So we're now north of $30 trillion, not sustainable. And it's something that we're going to have to deal with. I just don't know if the politicians have any truly any guts to tackle it. It's something that as Americans we're going to have to deal with. I'm not a big proponent of we need to aggressively pay down the debt. We're a country that's going to last forever. So is it okay if we pay this debt over a long period of time, or maybe never pay it off, just extend the payments? I think I'm okay being in that camp, but what we need to stop doing is keep digging a larger hole. And there's not really a political will for this. We can try to grow our way out of this, but we still need to have some restraints, and that's likely shrinking the size of the government. And so if you look at the spending numbers on the right-hand side, it just shows you what we're forecasting in terms of deficits, interest outlays, how much it's going to cost just to run our government in terms of interest. And in the bottom right, it just shows what we're forecasting to grow to from a federal net debt perspective. And so it's going to continue to grow as we go forward. The good news is consumer finances are really healthy. So we go back and the federal finances are a mess, and we go to consumer finances, we're really healthy. Look at our balance sheet. We have $171 trillion of assets in America, owned by, essentially owned by Americans. And then you look at our debt, we're at 20 trillion. So we have a really healthy balance sheet. Then you look at top right, we're looking at a household debt service ratio. So basically, debt payments is a percentage of disposable personal income. Still really low, right? We're still at lows that we've only seen over the last several years, and it's clearly lower than we saw in the 80s, 90s, 2000, 2010. So we're in a really good position. Now, the trend is higher because interest rates are higher. Coming out of COVID, people took on some debt. So the trend is moving higher, but we're still in a really healthy position. And then on the bottom right-hand side, we're starting to see some more delinquencies, but it's still not terrible. Next topic is recession. This is something that we seem to not be able to escape. Now that we're in 2024, one of the things to remember is that there was kind of a proof of a recession back in 2022. We had 2 consecutive quarters of negative GDP growth. So that was a technical rule of being in a recession. But I think because of, I guess, some of the political dynamics, we didn't call it a recession. But I would make the argument, and I have in prior conversations, that we are going through a weird dynamic, and we're not seeing traditional recessionary environments. Usually when you go through a recession, the whole economy pauses or stops or slows down. And then we go into a period of pain, which it could be 6 months, 9 months, 12 months. We find our way out of it, and then we start to recover and we get back to a growth path. This dynamic that we're seeing is very different. And what I mean by that, and this is just a different chart, I showed you one a year ago that's slightly different, but that we basically had these mini recessions and recoveries, and they're just hitting different industries at different times. And so that's what's making this traditional recession not look like a recession. So if you are working in an industry that's being impacted and you lose your job, that's kind of the definition of a depression, right? If you can't get back to work. But the reality is, what's been really interesting with our economy is, let's just look at these 4 examples. So on the left-hand side, and I know data is probably hard to see, so I'll do my best to explain each one, but it basically just shows some different data points we're going to look at travel, oil, housing, and semiconductors. So travel, so the first chart shows this, and we have these pink dots. The pink dots basically show the bottom, so what that would mean is you're in a recessionary environment, and that is the bottom. And that chart represents travelers that went through TSA. So obviously, the travel industry got hammered when COVID stopped the world, and now we've been recovering. So travel had its own mini depression that was pretty short-lived, but really painful. Then if we look at the chart to the right, oil. Well, oil kind of had the same thing going on, right? Because we had to stop the economy and slow everything down. They had the same problems in mid-2020. The oil markets have been on recovery as well, as pricing came down on crude oil. It got as low as sub $30 per barrel, and then on the recovery it bounced back, and now we've been kind of hovering in the 80 to 90 range for some time. If we look at the bottom left-hand side, when COVID first started, we had a little bit of challenge, but essentially the housing market boomed. People were relocating, so the housing market had a strong 2020, 21, 22. Interest rates were cut. Everything was working well in the housing market. Well, now the reality is, as rates have been going up, the housing market has struggled. So they're going through a little bit of a mini recession, but it looked like they're coming out of it. And I have more to follow on some of the housing. And then semiconductors. Semiconductors had this amazing boom in 2020, 21, 22, as we had more work from home. And so that industry did extremely well. 2022 was a really rough one. We had a contraction in the semiconductor stocks. And then now we're back, we're back in this recovery. And so I literally could do this for, 40 different industries. So the reality is, there's been leadership in the market that is alternating places. And that's actually quite healthy for the economy, because if 2 or 3 or 4 sectors struggle and people lose their jobs, they can pivot to those areas where jobs are needed. And yeah, you're going to have to get skills retraining. So it's a little bit of a challenge for society. But the reality is, that's why our recession has not really manifested itself in the way people have thought. And because you're still seeing that even today, that there's some industries that are showing real signs of strength, and some industries that are struggling. And I think that will continue, which is making this look and feel very different than before. Now, one thing I will tell you, kind of a potential problem. I don't want to read through this whole chart, but if you can see this, depending on what kind of screen you're looking at, on the left-hand side, it shows asset exposure by bank size. So the chart in the middle, or the 2 charts on the left-hand side says large banks, basically the top 25 banks, and then the middle one shows small, outside the top 25. And so inside that, you can see that the asset exposure by bank size in the small banks, otherwise known as regional banks, on their assets, this blue box on here, it says commercial real estate, 44%. So the one area that I do think there's some potential challenges that we don't really fully know is that we have started to see and a lot of commercial real estate starting to lose their value. And with these banks holding a really large percentage of them, that's a concern that I have, right? Because you want a healthy banking system for the economy, but that's the one thing as we go into this year, outside of the geopolitical risks that are happening in the Middle East and Europe or Eastern Europe. This is the one area that I think we have some concerns. So we're going to have to see how this unfolds. Now, I will tell you the Fed's playbook is pretty transparent and pretty well known. If the regional banks run into any problems like they did earlier last year, they'll likely flood the system with capital to save the banks, and then also probably cut interest rates. So those things would likely bode well for stocks and for the bond market in the long term, maybe not in the short term. But again, that's one of the challenges that I see. So this recessionary talk, I think over the last 2 years, we've been in a strange recessionary environment, but because it hasn't hit the whole economy at one time, it is not the traditional recession. And so we might escape what's known as a hard landing, which means a recession, with a soft landing, which means we kind of make our way through some of this pain. I don't know what that's going to look like, but I do know that there's a lot of resiliency that we're still seeing in our economy. All right, next topic, the Federal Reserve and interest rates. So this is definitely a topic that we're having pretty consistently, like what's the Fed going to do? What's happening with interest rates? Because this does have an impact on decisions that we make as consumers. I know people are delaying buying a car because now to finance that car, it's higher. They're delaying maybe doing a remodel if they were going to use their home equity line, right? People are waiting and seeing what's going to happen with rates. It's even happening in the real estate market where people are delaying purchases because interest rates are super high. Well, they're super high relative to the most recent numbers, but not that high if you look at them, if you look at them over the last 40 years. So I don't want to make you necessarily an expert on the real estate side, but basically what we're looking at is on the left-hand side of this chart, it shows what the Federal Reserve has been doing since January of 2022, where they basically went through a full year and a half, of interest rate hikes. They've been trying to fight inflation because, frankly, the Fed was behind the curve. When you look back at data, now we're all brilliant in hindsight, but when you look back at the data, they should have stopped basically stimulating the economy about 9 months prior to when they started raising rates. They should have actually done that way sooner. And the data was pretty clear at the time. They just made a mistake. They made a policy mistake. Now, in hindsight, it's easy for us to look at that and judge that, but they did make a mistake. Inflation was showing signs earlier on, and they did not pivot. So they had to raise rates sharply. It caused losses in the stock market, the bond market, the real estate market. And now what we're looking at is, okay, what's going to happen? So on the right-hand side, this just shows, okay, if we're in a current market environment, which means a mild recession, maybe no recession, interest rates are going to come down from current levels at about 5.5%, and they'll settle into somewhere between 3 and 4. So that's what that green line is showing. If we have a recession, and a painful recession, or a more painful one than we want to tolerate, then what this is forecasting is that we could see interest rates cut to below 2%. So right now we don't really know. I think I'm in the camp that Federal Reserve is trying to target getting to like a 3% range. Now this chart was just put in place to give you some history on what the Fed funds interest rate was going back to 1993. So you can see we're accustomed to having rates up in the 5 and 6s. This has happened many times over. Now, and all these sharp drops down, when we saw these declines, it was because we were heading into a recessionary environment. The Federal Reserve raised rates because of the strong economy, and then the economy overheated, economy fell, and then they had to start cutting rates. So it'll be interesting to see how we work our way through this, but it is clear, unless there's something in the system that's just unknown at this time, that the next move down will be a lowering of rates, and that the Federal Reserve target is to get to about 2.5%. So that's where they want to be. Frankly, barring some challenges with the banking system, I think we're going to probably stay in the 3 to 4% range for the next maybe 18 months. But we'll see. Those are things that we want to adjust, and that's why I do think those of us who are investing in bonds, we want to start looking at adding some duration, going a little bit longer term, beyond 2 to 5 years, getting out 5, 10 years, so that way we can lock in some of these higher rates now. All right, the next topic is the importance of diversification. Coming off of a year like last year where the Magnificent Seven drove most of the stock market returns, a lot of people might ask themselves, why do I need to be diversified? These are great tech companies, let's just own them. The reality is the Magnificent Seven is a really great list of companies. Arguably, we could say they're a little bit overvalued. Someone might even say they're way overvalued. But the reality is these are high caliber companies generating a lot of cash. And my job, I don't want to spend too much today just on that topic, but we do want to talk about the importance of diversification because I think this is relevant. When we start looking at some of the data points, and so on the left-hand side, this shows basically the top 10 stocks on the S&P and their returns for last year. So the top 10 stocks in the green generated a 62% return. The remaining 490 stocks actually averaged 8%. So the markets did quite well, but all of it was really driven by the top 10. And then we look over on the right-hand side, it shows us what percentage of these top 10 stocks do they represent in the S&P. So those top 10 stocks represent 32% of the S&P. So almost 1/3 of the entire S&P is just 10 stocks. That means the other 490 represent just 2/3 of the value in the market. And I think the thing that's a little bit alarming is that while they represent 32%, they only contribute 23% of the earnings or the profits. And we know over a long period of time, profits are one of the most important indicators of future stock market growth. So if these top stocks are representing 32% of the market, but only 23% of the profit, that tells me that over the next 3 to 5 years, that has to shift. And the returns have to broaden out across the market and not just be concentrated in these companies. Lots of data here, so I apologize. I'm sure on your end it might look really tiny. So we all know that markets are based, there's different types of markets, right? You have large companies, you have mid-size, you have small, you have value, you have growth, you have those that are blend, which means you can't really define them. And when we look, I just highlighted here on the 10-year, the 10-year returns for the growth sector has been really strong in the last 10 years. And the value sector has not been as strong. The small cap sector has really underperformed relative to large. And so that's just the reality of what we've just lived through. Now, when we look at valuations and say, okay, because valuations matter, right? Because I want to know, well, where are things going to head in the future? And valuations will drive that. And if we look at the bottom right corner, this just basically shows you, and this is measuring PE ratios, but this just shows you, if we look back over the last 20 years and say, okay, well, what do these markets tend to trade at? What's a fair price? And what it's telling us, as you can see on this chart, is if you look in the top right corner of this red box, that the large growth market is trading at 140% of its historical pricing, which means it's 40% above norm. And if you look at the bottom right, it shows small value is trading at 97% of its long-term norm. So it's 3% below. So that just gives you a sense of we do think returns are going to be okay this year and positive, even though there's going to be volatility. But we think some of these market valuations are going to drive some of the returns away from large growth and into some other areas. Now, we do know these cycles can play out over a long period of time. We've lived through a really nice, healthy 10-year cycle. But I think the key here is not trying to we're not making bets saying that this part of the market has to do well. What we're advising and what we're doing is that we want to make sure we rebalance portfolios, right? When you have parts of your accounts doing extremely well, those are good times to take some profits and reallocate to those that are maybe out of favor, maybe a little bit cheaper. And so those are the things that we're doing actively. And that's just a good reminder of you're never going to be able to figure out the perfect time to invest in any one of these investment style boxes. But you want to have discipline about how you balance and manage the portfolio. This is one of my favorites when you talk about diversification, and there's a lot of data here, but just kind of follow along with me line by line. So this was just a piece put together. The data came out of Morningstar, and they put together a sample portfolio. This is not the portfolios we manage. This is just illustrative purposes. You can see all the makeup on the top. But over the last 20 years, this was just kind of that dynamic that if you were in that allocation, and that would, I believe it's rebalanced annually, these were some of the numbers. So I'm going to go through and you can see. So 2000 to 2002, the S&P was down 40. A diversified portfolio was down 16. What's your emotion on the right-hand side? So again, this just comes back to diversification, but then your emotion. Your emotion is, oh, I lost money, right? Then we had 2003 to 2007. S&P was up 82, diversified portfolio up 91. Oh, diversification worked. Okay, great. 2008, stock market lost 37, diversified portfolio lost 28. What's your emotional reaction? I lost money. 2009 to 2019, that's a 10-year period. S&P up 351, diversified portfolio up 237. What's your emotion? I didn't make as much, right? And so you go through this litany. Now, last year, or let's look at the last 2 years as we make our way down to the bottom. 2022, S&P down 18, diversified portfolio down 15. What's your emotional reaction? I lost money. 2023, S&P up 26, diversified portfolio up 15.9. What's my reaction? I didn't make as much money. But when you look at the cumulative impact, and this actually shows a dollar amount of 100,000 invested basically in 2000, that you got to the same result. You got to the same result with less volatility. So that bottom right emotion is diversification can work even when it feels like losing. And it's important to remember that market returns year to year are varied and not predictable. And so that's why just having good discipline about how you diversify, how you rebalance is really critical. Okay, so I'm going to go through a little bit of some just rapid fire slides on different topics. And this is primarily for the people that are live, because for all you, everyone else, we're going to go through and create chapters of this content. Let me just see how we're doing. Okay, all right. So growth versus value. So growth versus value as a topic. So growth investments versus value investments. When we look back over the last 25 years or so, there are periods of time, and the chart on the left shows that we can measure when growth is cheap relative to value stocks and when value stocks are cheap relative to growth. These cycles tend to last in longer period of times, but you can see prior to the .com on the left-hand side, that big trough, which I'll highlight here, the bottom left in red, that shows a period where value was really cheap and growth was expensive. And if any of you remember, at the time of the .com bubble bursting, growth stocks, like represented by technology, were down north of 70% over the next 3 years. So massive losses, and value stocks did really well. And then you can see what I highlighted in red in the middle of the screen. This just shows where we are right now. Value is cheap relative to growth. But frankly, if you look at that chart, that shows that actually value's been cheaper than growth for the past 5 years or so. So just because it's here doesn't mean it has to change. But we do believe that, again, maintaining that balance is just the right portfolio discipline. When we see portfolios coming in of non-clients, we are seeing growth portfolios a lot heavier. And I think it's because people are kind of riding that wave and staying in growth and not recognizing that, okay, we're kind of getting into the cycle. Maybe we should start balancing that out. When we look at the right-hand side, whoops, let me go back. When we look at the right-hand side, this just shows, based on where the treasury is, and what tends to do better or worse. And so this shows that when interest rates are really low, growth stocks do better. And when interest rates are higher, meaning higher above 3%, there tends to be an advantage on the value side. So right now, we're kind of in the mix of, like, just based on the right chart, is that, growth value might be a tie here on a go-forward basis. But from a valuation perspective, we do see that that value seems to be more attractive. Again, at this point, it's cheaper. Cheaper doesn't always mean better, but over the long term, it can mean that that's going to be a better place to be. But again, from our perspective, we still want to maintain that diversification and not trying to guess what's the best. Let's just own both. US versus international. So this is another topic on, we don't necessarily need to choose between one or the other. The answer is let's do both, and do both in what degree. That's unique to each individual investor. But this goes back to 1971. So this shows periods of time represented in gray where the US markets outperform the broad international markets. And that's measured by the IFE, which is Europe, Asia, and the Far East. So that's the IFE. And so you can see periods of time where US outperformed. If you look on the far right-hand side, I don't know, I did not highlight anything on this one. You can see that the US market since basically 2009 or so has outperformed international markets by 277%. We've had some of these periods in the past. If you look right in the middle, the purple, international outperforming by 300% over a 5-year period. Back in the late 90s, US markets outperformed. So this is not uncommon to see these periods of time. One of the things that we have recognized that a lot of this is driven based on what's happening with the dollar. And so for those of you who don't know, the dollar has been fairly strong. Even though we're printing all this money, even though we have massive deficits, the dollars continue to be really strong. And the reality is the last time the dollar was weak is on this chart that I have exhibited here that has the red box. So from 2003 to 2009, basically we saw the dollar weakened against European currencies, and so, or world currencies, excuse me. And so that was a period of time where the international markets did really well. So if you just look at the numbers at the bottom of this chart from 03 to 09, and I go back and you actually look at this purple chart, I don't know, whoops, right here in the middle, if you can see my cursor, up 65% over that period of time. So that was a period where the dollar was losing value. And then what we've lived through over the last basically 15 years is dollar strength. So what this chart is showing is price earnings discount. So normally the US trades at a higher multiple, meaning more expensive. And it's because we have stronger regulatory system, we have better property rights, we have better demographics, we have a lot of things in our favor, better innovation, more growth, more tech companies, things that have really driven. We are now at a point with international markets where they're so far below historical valuations that they're trading at basically a 35% discount. And there's plenty of reasons why it should be trading at that level of a discount. But we believe it's overdone, and we think that we're going to start seeing potentially a cycle of 3, 5, 10 years where international starts to perform in line, but likely we think it's going to perform better, but we don't know. So again, this is not a case of US versus international. It's a case of make sure you maintain that diversification. What you don't want to do, a lot of people have been globally diversified, meaning owning both, and they're kind of feeling like they want to throw the towel in, but you don't want to do that at a time where valuations are attractive on a go-forward basis. And again, those are the things we always want to look at is, while we have a tendency to look in the rearview mirror, we want to look ahead and we want to look for the opportunities that lie ahead of us. And, while Europe has some struggles, I don't know if you've noticed, but India is quickly surpassing China, has surpassed China in population. You're seeing tremendous growth. There are lots of pockets around the world that are thriving, and they have demographic shifts that are really really healthy for growth. And so we want to be mindful of, again, global diversification, still with a US bias, but be mindful that there's some good opportunities outside of our borders. All right, next topic, large cap versus small and mid cap. So cap means capitalization or company size. So large companies, I think right now the technical definition are companies over 15 billion, small cap and mid cap are below that. Historically, if you just look back over the last 100 years, small and mid tend to perform slightly better, about 1% or 2% per year over a long period of time, mainly because they have the advantage of being smaller, right? It's easier to grow when you're smaller size, right? Once you reach some level of size, it's harder to keep the same growth rates. So when we look at what's been happening now, I do recognize I have a fair amount of noise on here, and we'll be able to share this slide if you would like. But when we look at what's happening in the portfolio, we want to make sure this left-hand chart basically shows that large is very expensive relative to small. We haven't seen this level of being expensive since back in 1998, and that was right before the dot-com. So this actually shows us and gives us confidence that we think small caps are going to start participating in a better way. But again, it's not a matter of owning large or small and mid. It's owning all of them in a proper allocation percentage to build your portfolio. When we start then looking over on the right-hand side, it basically just shows the average annual total return during small cap bull markets, right? It shows, how when you get these rallies that happen in small cap, they tend to happen quickly. And then the thing you want to be careful of is, like, a lot of times people, instead of being broadly diversified, try to pick okay, I just want to be in large caps because they're doing well and they avoid other areas. And this chart basically shows that this average small cap return during a small cap small cap bull market has averaged 29%. Right, that's a really strong rate of return. And then if we look at if you just miss the best month, now your returns, instead of being 30%, are closer to 25. If you miss a few months, the best 5, now you're down to 11. So it's really important just to have this as part of your ongoing diversified strategy. So, with us managing the money, we're already doing that on your behalf. If you have outside 401ks, this might be something you want to be looking at. All right, so we are in an election year. So I want to go through some election year stats. There's always conventional wisdom around what's better, what's not better. So I'm going to try to maybe cover some of the myths and just give you my general thoughts on the election year and what this looks like I just got a question pop up. I'm going to hold off and come back to that. I don't know if they're just excited they're waiting for my election slide or if it's a different topic, but I'm going to make sure I'm going to come back to that. So election year stats. Let's just go through what does an election year tend to look like? So the first thing I want to start with is this idea of consumer confidence, right? This is just measuring investor psychology and behavior. And if you look at what the chart we have in front of you, this goes from 2000 all the way to 2023, so now. And it shows you these periods of time where you had Bush, which is the first 8 years on this chart. Then you had Obama, which is the next 8 years. Then you had Trump, the next 4, and then Biden on the chart 3, right? Because we're halfway, it's because we're in the fourth year. The dotted line represents the change when they basically the election day. And what's pretty crazy about this is, and it's not a surprise, when a Republican's in office, what tends to happen, just look at the 2000 and 2008 years. What's the consumer confidence of people? Well, during the Bush time, Republicans, or lean Republican in the red, represented really, people were really confident. And then you look at how the Democrats, or leaning Democrats, which is the blue, which is at the bottom, really low confidence. Now, once we had the election going from Bush to Obama, confidence was really low because we were going through the financial crisis. And through Obama's 2 terms, confidence rose on both sides. But if you notice, what happened is the Democrats rose more. Again, this is consumer confidence, is people's how they feel. And it does follow party lines, and that makes sense. Then you can see once Trump was elected back in election day in 16, I think it's 16, you can see the spike in consumer confidence that we saw from 17 all the way through about 20. And then obviously COVID hit, that dropped it down. And then you can see, unfortunately, where we are. So the reality is consumer confidence, number one, driven on what's your political affiliation, your political party. That drives a lot of it. But also, I think that because of the news cycle we just have a lot more pessimism built into things. I mean, it's pretty crazy. We're seeing markets hit all-time highs, and to see this level of pessimism is not great. Hopefully we'll get that turned around. But one of the things just to recognize is we have I don't know if it's a joke, it's more of an internal observation that depending on who is in political power, we empathize with our clients when the party that they favor is out of office, because I think it drives a lot of decisions, and it drives more anxiety, right? When you have your party in control, your confidence goes up. And so just be mindful of that. We don't think, if you look at historical data, that yes, there are impacts by politicians, how they make decisions. I'm not trying to be naive about that. But when you look over the long term, the thing that some of this data will show us is that markets tend to do well in spite of whoever's in office. And so this data goes back, our starting point is 1936, and it basically shows periods, what's called the 10-year annualized returns during periods of Democrats, Republicans, and you can see there's a slight edge on the Democrat side, 11.2% versus 10.5%, but fairly insignificant. You can see periods of time during like the Reagan years where the markets did really well. And then you can see times through like Obama did really well, during Trump, during Bush, during 9/11 and the .com did not do well, right? So you can see the cycles here. So this just represents the growth of 10,000 over during these periods if you invested at the start of an election year. So you can see over this period of time, it's like there's a lot of uncertainty, but this should not drive any decision that we make, you make. At this point, it's just noise. The reality is, though, just wanted to make you aware of this. If we go back and look at the first half of the presidential election year, it tends to be sluggish. So this is data going back to 1926. The first half of the year tends to be sluggish, and the second half is strong. Not that this is going to repeat itself. It was more just an FYI. So again, many of you are constant and consistent investors. Just means you just kind of invest through this, and that we're going to have volatility, and that's okay. That's part of it. We don't want to have our political affiliation drive our decisions, because if you look back over 10 years, 20 years, 30 years, 50 years, 100 years, that has not been a proven way to be successful. Being successful is being a long-term investor in America, whether it's being in stocks or real estate or businesses. That's how you do well over time. And again, this is a lot of noise. And unfortunately, we're going to go into a really noisy environment. So it's going to be really important upon all of us to have discipline, have pause, make sure we ignore a lot of the noise and remember our goals, remember what's important to us, and not get caught up in a lot of the mess that's coming. And it started, I think we had the Iowa caucuses last night, or for the Republican Party. And so that's all starting. So we got to kind of hold on for this ride, because it's never a fun one, but it's the reality. Okay, I'm going to give you a quick real estate update, just a couple slides on here. And this comes from PGIM, which is Prudential has a real estate group. I got some good slides from them. So one of the things that's happening in the commercial real estate market, this is not residential, this is basically private U.S. real estate, is that values fell by over 8% in the first 3 quarters of this year. And so if those of you in the real estate business, this will make a lot of sense. If you're not in the real estate business, it might be a little bit confusing. But one of the things when you value real estate, what do you value it on? Well, number one is income. Does it generate cash flow? But it's also highly dependent on interest rates and something called cap rates. So when interest rates are going down, the value of real estate goes up, because interest rates drop, making that property more attractive, because lending costs go down, and it basically will move cap rates down. And when capitalization rates go down, it causes the value to go up. So this chart that we're seeing here, it's really easy to understand. When you go through an environment where cap rates go up, and this one, cap rates have gone up, and it's driven by higher interest rates, the value of property goes down. So on the right-hand side, you can see this 2023, is that you've actually seen real estate generate income, and you've had some net operating income growth, which is positive. But the effect of these adjustments on these capital rates has really hurt pricing. So that's the reality of what's happening. That's not likely to change here anytime soon, but that's the reality. If the Fed starts to lower rates, that will improve it slightly. But real estate prices, frankly, got a little overheated in some sectors of the real estate market, as well as some parts of the country in terms of different states. So we're starting to see some softness and correction there, which is healthy, right? Real estate for a while there was going gangbusters in one direction, and it's not sustainable. So we're getting a little healthy pullback here. One of the things that's happening is we're seeing a big difference. If you look at the right-hand side, we're going to focus on this, is basically that you're seeing the blue line is appraisals, what properties are appraising at. And this example is based on the apartment sector, and then what transactions are occurring. So right now you can see there's a big gap between the appraised value and the purple and the pink value. The pink value is what the transactions are. So we're still seeing appraisals way down, which means people are still potentially overpaying for apartment sectors, and we haven't seen the pricing come back down. They are adjusting, but they haven't come back down to the extent that the appraisals would suggest. So that's kind of an interesting thing, because I've been hearing for the last 10 years, oh, you can't lose on apartments. They're always going to go up. And yeah, people need a place to live. They're good long-term investments, but pricing got a little bit sideways. And so we're now starting to see that right size itself, fix itself. The last piece of dealing with residential, which I think for most of you on this call is kind of the more relevant conversation. A couple things we want to talk about. On the left-hand side, we have a massive deficit in housing. We basically, so if you look in this light blue box, this is estimated by the PGIM real estate team. We need, basically an additional 15 million housing units over the next decade due to population growth or obsolescence. So in addition to our current deficit, we need another 15 million. So there's likely going to be continued boom in the housing sector. That's obviously great for the economy. Strong residential real estate is good. So even though there's pessimism out there about a lot of areas, because we are underbuilt in this area, and we have we have a lot of immigrants here, and we're going to continue to have more. We don't really have great population growth because as Americans, we're not having enough kids, but we're going to continue to have more people moving to the U.S., which is great for the economy. And so, but we got to build homes. And then if you look at the far right-hand side, the reality is, cost to own versus cost to rent, for the last 20 years has been fairly aligned. And then you can see right now on the far right-hand side, the big gap has jumped. The cost to own has gone up substantially. That's all because of interest rate moves and because of home prices really accelerated post-COVID. So we saw home prices go up too quickly, and interest rates now have gone up, which now is creating this level of lower affordability. So that'll start to fix itself, but because we have such a deficit in housing, I don't know if this is an analogy, but the way I describe this is that I'm not of the opinion that the housing market's going to come crashing down. What's probably going to happen is it's going to bounce along and go sideways for a period of time until pricing catches up, or until some of this inventory is built. So, because real estate can do one of two things, right? It can keep going up, it can go sideways, or it can go down. And my estimation is we're probably going to meander and bounce around a little bit because we got this post-COVID bounce where pricing really bumped up, and we're going to start seeing things go sideways. Now, clearly, there's going to be homes that are way overpriced that are going to have to come back down. But I think generally for most people, it's going to be a leveling effect. Additionally, many people, including me, if I wanted to move, I'm not, because I'm in a 3% mortgage. So, that's going to keep people from moving and putting more inventory on the market. So that's just the update on real estate for 2024. But it does look longer term over the next let's say 5 to 10 years, that there's some really strong headwinds because of our lack of supply in housing units. Okay, so that wraps our economic and market update. I know I ran a little longer than normal. I don't know how many stayed on with me. Hopefully this was valuable. Again, we're going to be putting this into chapters and segmenting this into some smaller topics. Anything that had a transition slide will be a shorter topic around whatever the topic was listed on there. I hope you found that valuable. If you are a client, just know our team will be reaching out to you in the next coming months to schedule your annual review. For whatever reason you want to accelerate that because something's going on in your life, feel free to reach out to our office so we can get you on the calendar. And I hope you're doing well. So Happy New Year. If we have any prospective clients on here that would like to have a consultation with one of our advisors, please scan the QR code and we can get you scheduled with a complimentary consultation. And again, for all of you on the call, don't keep us a secret. If you have anyone that you think could benefit from some of the guidance we provide, please refer them to us. We'll take great care of them. We do have a growing team here, so we're ready and able to accommodate taking on new clients, which we view as just new families that we can take care of and support. I do have a webinar coming up. This is going to be a little bit more business owner focused. Around some of the employment law changes in California. So for those of you who are just curious of some of the chaos and craziness of California, it's a great topic. For those of you who are in the business world, it's kind of a must attend, which will be on Thursday, February 15th at 11 a.m. I do have a couple questions here, so I'm going to just go ahead and see if we can get those in here before we go. Okay, so let's see. I just got a thank you, so that's perfect. You're welcome. I got another thank you. So, all right, I like the questions that are thank you. So it's my pleasure. Hopefully this was helpful. I did have a question. It says, what are your thoughts / concerns about the dollar no longer being the world currency and the ramifications for that for the U.S. and portfolios? So there has been a lot of that chatter. Now, this chatter is happening everywhere in terms of moving to more digital currencies. There's been chatter of, basically China, Russia, Brazil, a bunch of countries trying to come away from that, come away from the dollar as the world currency. There's plenty of chatter of like the Middle East and the way oil is priced coming away from the dollar. Clearly, if we come away from the dollar in the magnitude that is being reported, that would not be great because the dollar would decline in value, and we want to have a strong dollar. I do think it's way overblown though, because at the end of the day, even though we do print money, even though we have pretty big deficits, our innovation and our property rights are probably the best in the world in terms of protecting assets and protecting, our property. And so that's where I still think the dollar becomes a really good safe haven. And it's like, what are people going to switch to, right? So if not the dollar, then what? China? Are we going to trust the Chinese government to have that? And so there's going to be some shift. We do think, and again, we'll see how this unfolds, the dollar is probably going to decline. When we look back over the next 10 years, the dollar is probably going to weaken a little bit. To what degree, I don't know. But I do think that's why we will maintain diversification, because if the dollar declines, our international investments will go up in value. So again, that's another reason why we want to be diversified. But I don't think that we're at a point where we should be overly concerned with the dollar not being the world currency. And again, it's probably going to lose some of its historical, I guess, position as a world currency, because other countries that don't like us want to move off of it. But there's plenty that still trust the way we handle our managing our currency. And so there will be some changes, but I don't think to the magnitude of what's being reported. So hopefully that's helpful. So again, that comes back to diversification, and that's a big part of what we believe in to make an impact for clients. So everyone have a great evening and have a great year. Happy New Year. Cheers to 2024. Thanks.